It's like if you had a family member who for the past 20 plus years has asked you for money and says, this year it's different. This year they're going to do all these things with this money. They're going to start a business. They're going to pay off debt. They're going to do all these great things with this money. And then they don't. They waste it. And then the next year they come back to you, same story for 20 plus years. At what point would you say no? Well, this has been the craziest, most eventful election of my lifetime by far. Every week there seems to be a new surprise, and occasionally we will get a policy proposal, particularly around taxes. As a CPA, that's very interesting to me. So I want to focus on one tax proposal put out by the Harris campaign that has been making the rounds over the past week, and that is the taxation of unrealized gains. But before we get into that, just a friendly reminder that the United States is $35 trillion, $263 billion, $302 million in debt. Just always keep that in the back of your mind. The idea of taxing unrealized gains is not a new idea. This actually came out in Biden's 2025 budget proposal back in March of 2024, but it's getting a little bit of a resurgence because somebody from the Harris campaign mentioned that Harris is likely to stay in line with Biden's 2025 budget proposal and its plan to increase the corporate tax rate to 28% from the 21% set by Trump's 2017 tax overhaul, which was included in this budget proposal. One of the many things included in here, I'm not going to go through all of them, obviously, but it also included closing some tax loopholes and then imposing a minimum tax on the wealthiest taxpayers. And this is the section that gets into the taxation of unrealized gains. So currently, how investment gains are taxed is you only pay tax once the investments are sold or the investment gains are realized. And those are taxed at your ordinary income tax rate, this tax bracket right here, if you hold the investment for 1 year or less. If you hold that investment longer than 1 year before selling it, then those gains are taxed at a lower preferential capital gains rate, this 0, 15, 20% here. But that's on investment income that is realized or received. Currently, it's not taxable until you sell it. But this proposal would change that for certain taxpayers. It would provide the ability to impose a tax on gains that have not yet been realized. Obviously, there has been a lot of takes, a lot of opinions over here on Twitter or X. Grant Cardone, Biden administration proposing tax on unrealized gains at 25%. Imagine your home or stock went up by $400,000 and you would owe $25,000 without selling it. Another attempt to destroy middle class America. That math doesn't work out there, but you get his point. Mosey says taxing people on unrealized capital gains is like asking people to pay income tax before they get their paycheck. And then on the flip side, you have Axios and a lot of other people saying this would really only impact a small subset of America's wealthiest people, and most tech founders and investors and your average American would be spared. I want to get into what does it actually say. I think that's what's important because there are some things that are missed. I'm not going to read through all of it, but just hit on some important points. So it starts by going through the current law, which I talked about, the reasons for the change, why unrealized gains should be included in the income calculation, and then the proposal itself. Starting off with, the proposal would impose a minimum tax of 25% on total income, which includes unrealized capital gains for all taxpayers with wealth or net worth, essentially, greater than $100 million. So that minimum 25% tax is new. And an even bigger new attribute here is the inclusion of unrealized capital gains in income. Now, it talks further down below in paragraph 5 who this applies to. It's a phase in to 200 million. So this calculation starts at $100 million in net worth and then would be fully implemented at $200 million in net worth. Another important point here is that the payments of the minimum tax would be treated as a prepayment available to be credited against subsequent taxes on realized capital gains to avoid taxing the same amount of gain more than once. So basically, any tax payments that I make on unrealized gains count towards a credit for taxes on realized gains. So I'm not going to, let's say in 2024, I have $1 million of unrealized gains in Apple stock, and I pay tax on that when I go file my 2024 tax return. And then let's say in 2025, the stock goes down and I realize a gain of $700,000. Well, I'm not going to pay another tax on that realized portion. The tax that I paid on the unrealized will apply to that realized. And I actually paid taxes on $300,000 more than I actually realized. So that tax that I paid would either apply to future realized income or it would be a refund. And there are some some requirements and details around that I'm not going to get into. Here's another fun part. Taxpayers with wealth greater than the threshold would be required to report to the IRS on an annual basis, separately by asset class, the total basis and total estimated value as of the end of the year of their assets in each specified asset class, and the total amount of liabilities. Basically, a detailed net worth statement is what they would need to provide to the IRS every year. Kind of similar to what businesses do, but this would be now for very high net worth individuals. And then it gets into an important point, which is tradable assets versus non-tradable assets, because not every asset these people own, particularly non-liquid assets like real estate and businesses, you don't value those every year. The value of those is not easily obtainable. So for tradable assets like stocks and bonds, you would use the value at the end of the year. That's what would determine the unrealized gain. Now with non-tradable assets, you wouldn't need to go get a valuation every year. You would use the most recent, the greater of the original cost basis or the last valuation. And then they would apply a annual, what they consider a conservative floating annual return, the 5-year treasury rate plus 2 percentage points. They would apply to that most recent valuation. And that's what would determine your gain or the valuation for the year. Another big question that people have is, okay, well, how are people supposed to pay if you haven't realized these gains yet? How are you supposed to pay the tax? So this is where they break up between liquid and illiquid taxpayers. So if 80% of your wealth is in non-liquid assets, then you would not be subject to this. So this would probably not apply to Grant Cardone and Alex Hormozy. Imagine most of their wealth is in businesses and real estate. But yeah, basically, if you have less than 20% of your wealth in liquid assets, you could be exempt. But there's a big caveat here, and that is if you choose that approach, you are considered an illiquid taxpayer. You won't pay taxes on unrealized gains before they're realized, but then once they're realized, there's a deferral charge. So there's like an additional tax that could be up to 10% that would apply to those realized gains. So not only would you pay tax on those realized gains, but because you didn't pay tax on when it was unrealized, then there's this additional surcharge, this additional tax that you would pay on those realized gains. So they kind of get you on the back end there. And they talk a little bit about making estimated tax payments. This is an important note here. The proposal would provide the Secretary with the authority to prescribe such regulations or other guidance determined to be necessary or appropriate to carry out the purposes of the proposal, including rules to prevent taxpayers from inappropriately converting tradable assets to non-tradable assets. That's pretty vague, but that's a bold statement that is essentially restricting what it sounds like. It would restrict people from moving from liquid assets to illiquid assets to avoid paying that tax on the unrealized portion. So in order to defer taxes, I have a hard time seeing how that would actually get passed, or honestly, how any of this would get passed, to the point that Axios and a lot of other people were making. Yes, this proposal only applies to the ultra wealthy. For people in that net worth range or above that net worth, you're probably looking at 20 to 30,000 people. So a very small portion of the population. But here's the big concern is if you redefine income to include unrealized gains, does that open the door for other people eventually at some point to get taxed on their unrealized gains? Back when the income tax was first introduced, like back in 1913, less than 1% of the population paid income taxes at the rate of only 1% of net income. So it's a very small portion. Obviously, a much larger portion of the population now pays taxes at a much higher rate. So I think that's the concern with this unrealized gain tax if it were to ever be implemented. There's also this growing sense of frustration with increasing taxes when the U.S. government can't even manage what they have now. So in 2023, the U.S. government brought in $4.44 trillion in revenue, but we spent $6.13 trillion. And this has been a trend for the last 22 years. We have been in a budget deficit, meaning we've spent more than we've made every year since 2000, all the way back through 2002. 2001 was the last year we had a budget surplus. So there's not a lot of confidence that if tax revenues increase, that those extra dollars will be stewarded. It's like if you had a family member who for the past 20 plus years has asked you for money and says, this year it's different. This year they're going to do all these things with this money. They're going to start a business. They're going to pay off debt. They do all these great things with this money. And then they don't. They waste it. And then the next year they come back to you, same story for 20 plus years. At what point would you say no? Or another example, it would be like giving your teenager a check for just writing them a check for $10,000, and they can't even handle the $1,000 paycheck that they get. They just waste it on, I don't know what teenagers are buying these days, high socks and bad haircuts, I guess. Now, I'm in no way advocating for tax evasion as much as I hate taxes. I'm just saying there's a good reason that people are pissed off about these new proposals. Now, the idea of paying a tax on the value of an asset is not entirely new. We do that with property taxes now. I think I pay, 0.5 to 0.7% of the value of my home to my county every year. So it's not an income tax, but it is a tax that I pay to my county. It's not 25%. It's very small. It's less than 1%. So there is that. The only other area that I could think of that was kind of similar to this is required minimum distributions from your retirement accounts. So once you hit age, your early 70s, depending on when you were born, you're required to take withdrawals from your traditional IRA and your traditional 401k. So while you don't pay a tax on the unrealized portion, the government basically forces you to realize it so that they can collect taxes. But you actually do receive, money in that exchange. So it's a forced liquidation. That's the closest thing that I could see. Where I think that this whole idea of taxing unrealized gains would get us into problems is I think it would push the ultra wealthy. It would push a lot of money from liquid investments to illiquid investments, making the stock market less efficient. I think it would de-incentivize people from investing in the stock market, which has been a wealth building tool for 100 plus years. And logistically, it would be a mess, but that's nothing new. That's, all tax laws are a mess when they're first introduced. Actually, pretty much all the time. But more concerning is, does this set the precedent for taxing unrealized gains at the federal level for everyone eventually? TBD on that, I guess. But really, I don't think this is going to get passed. I very much doubt it. I don't even really see this getting to a point where it's voted on. And for a few different reasons. Number one, the large majority of politicians cater to donors. And it would not bode well for them to implement policies that would substantially negatively hurt their biggest donors. You can go look at who are the people that contribute to both parties. It's very wealthy people. Those are the big donors. And a lot of those people would fall into this taxation of unrealized gains. And, I know, making the rich pay their fair share. That's a nice talking point. It gets people riled up. But in the end, those are really the people that are calling the shots. They're the top 1% of the top 1%. And I don't think that it would get enough support from enough people to actually pass. Now, if it were to somehow eventually get proposed and passed and signed into law, I think it would immediately get challenged in court. And I think the Supreme Court would shut this down. One of the most famous cases relating to the taxation of income was this Eisner versus Macomber case back in 1920. Long time ago, a lot has changed since then. And it wasn't exactly this situation, but it was a case where they defined income as the gain derived from capital, from labor, or from both combined, including profit gained through the sale or conversion of capital. And so while it was, 100 plus years ago, this is one of the cases that people refer to when they're making an argument against the taxation of unrealized gains, is because that asset has not been sold yet. But these things tend to change gradually over time. I think 100 years ago, I don't think people could have imagined the complexity of the tax code of what it's become today. So only time will tell.